Hi friends, welcome back to EduTap. So in the previous lecture, we talked about introduction to accounting. We talked about the basic concepts of accounting. So now we are going to move forward and we are going to talk about the theory base of accounting. So this is again a very important topic from examination perspective, a very basic topic, but a very important one. You should definitely know about this topic if you have to study more about accounting, because they are the basic assumptions on which entire accounting is done. So let's start our discussion on these MCQs. So let's start with the first question. Which of the following is not one of the basic accounting concepts? So friends, there are some basic accounting concepts. So these concepts, they are to be followed by each and every one. Every accountant is going to follow them while preparing accounts. Every company, every business, each and every person in this world is going to follow these particular concepts. So we are being asked which is not one of the basic concepts: business entity, going concern, conservatism, limited liability, or matching. So let's talk about basic accounting concepts. So as the name suggests, they are the basic ones. They are the ones which are going to be fundamental accounting concepts to be followed by each and everyone. So it says that they are the basic assumptions which underline the theory and practice of financial accounting. So even if you have studied science, even if you have studied anything, you would know that there are always some assumptions which are made before studying anything. Before giving out any theory, we always make out certain assumptions. So in accounting also, we always take certain assumptions before finalizing our accounts, before preparing our accounts. So you must be aware what are those assumptions. Then only you will be able to get a true picture. You will be able to understand what the accounts are going to say. So every accountant, every person who is related with finance in any way, every person who is preparing for commerce for any exam, he or she should definitely know what are these basic accounting concepts. So these are the broad working rules for all the accounting activities. If they are not followed, each and every person follows his or her own rules, then the things are going to get haphazard. You won't be able to compare balance sheet of one company with another if nobody follows these basic accounting concepts. So first one is business entity concept. So let's just take a quick overview also. What are these concepts? Business entity concept, it says that a business and the owner, they both are separate. We are preparing the books of accounts of the business and not the owner. Money measurement concept, it says we are going to only record those transactions in our books of accounts that are measurable in money terms. So we are not going to record honesty of the employees in books of accounts because it cannot be measured in monetary terms. Next is going concern. It's like men may come, men may go, but the river goes on forever. Similar is the case. When we are preparing the books of accounts, we assume that the business is going to continue till eternity. Business is going to continue indefinitely or at least a long considerable period of time. Then is accounting period concept. So just now I said that the business is going to continue for a very long period of time. So we have to know what is the profit that the business is making. We cannot wait till the business is closed after so many years to know the profit made. So at regular intervals, the books of accounts, they are closed. Balance sheet, P&L account, they are prepared to know the profit or loss of the business. Generally, it is prepared annually. On 31st of March, we usually close our books of accounts to know how much profit we have made in the preceding financial year. Then is the cost concept. Now this concept says everything you record in your books of accounts should be based on the cost of that particular thing. Now suppose what happens, I bought a land for my business for rupees 1 lakh in 1992. Now the present worth of the land is rupees 1 crore. But still, whenever I am going to prepare my balance sheet, I am going to show land at only rupees 1 lakh and not rupees 1 crore. We only account for the cost in our financial statements and not for the current market value. Next is dual aspect or the concept of duality. It says every transaction, it has two aspects. We already know the fundamental accounting equation that assets are going to be equal to liabilities plus capital. Revenue recognition, it says you are only going to record the revenue when you are able to realize it. When you are sure that revenue is going to be yours, you are going to make money on this particular sales, you recognize that particular revenue in your books of accounts. Then is the matching concept. The matching concept says you have to match your expenses and your income. Now suppose in 2020 what happened? I bought 20 phones and I sold 10 phones, and the remaining 10 phones I sold in 2021. In 2021 I sold the remaining 10 phones. So what this matching concept says, that in 2020 you should only match the cost of 10 phones with the sale price of 10 phones. You should match your cost with your revenue. So this is what you should do. And the remaining 10 phones, they are going to be your closing stock. It is going to be stock in hand, and its cost is going to be considered in 2021 when you sold those remaining 10 phones. So this is about the matching concept. Then is full disclosure. It says when you are preparing your books of accounts, you should disclose each and everything. You should not hide anything from the users of accounting information. Then is consistency. It says be consistent. If you are in 1 year following some accounting policy, also then that accounting policy should also be followed in the coming year as well. We already know that comparability is very important. So if different accounting policies are followed in different years, then consistency is not going to be there, and we are not going to be able to compare the financial statements of 2 years. Then is conservatism or prudence. It says you always have to be conservative. You cannot anticipate any gain, but you have to record all possible expenses or losses which you feel are going to happen. So you have to be conservative. You cannot just go ahead and predict all your incomes beforehand, but if you are feeling that some expense may be there, you have to record it now. Then is materiality. Now it says that all material aspects should be recorded in the books of accounts. Now it says, that full disclosure principle, it does not mean that if you bought a pen, if you bought a sharpener, if you bought an eraser, 2 rupees, 5 rupees, 7 rupees, you have to disclose them separately in the books of accounts. Materiality says that you should disclose all the material items in the books of accounts. You can club all those pen, pencil, sharpener in one stationery head and show it as stationery item in your financial statements. So these all basic accounting concepts, they are there. Now another concept is objectivity. It says that every accounting term, everything that you are putting in your books of accounts, every transaction, it should have proper evidence with it. So suppose if you are recording purchase of mobile phones in your books of accounts, you should have a proper voucher, proper bill for that particular transaction. So everything should be objectively verifiable through proper documentation. So now we can easily answer this question, that out of these particular options which are there, business entity, going concern, conservatism and matching, they are basic accounting concepts. Limited liability is not a basic accounting concept. So this is going to be the answer for this particular question. Now let's move on to the next question. Now friends, if you have understood the first question and the explanation behind it very clearly, then you will be able to handle all the remaining questions. So if you are not yet thorough with the first question or its explanation, I would just recommend you to go back and just listen to it again. Then the other questions, they are going to become very, very easy for you. So this question is, the owner of the firm records his medical expenses in the firm's income statement. Which accounting principle is violated here? Prudence, cost, entity, full disclosure, or none of the above? So I'm expecting you might have spotted the right answer here as of now from the explanation of the previous question itself. So we learned about business entity concept. We learned that the businessman and the business, they both are separate things. If businessman is incurring personal expenditure, that is not to be recorded in the books of accounts. Only business related transactions, they are going to be recorded in the books of accounts. So both are to be treated as different persons. Now a very interesting fact that you should know is that the money that a businessman invests in the business, it is shown on the liabilities and the capital side of the balance sheet. It is referred to as capital and it is shown along with the liabilities. So a balance sheet, it basically has two sides. On one side you show what are the things that the business own, what are your assets, and on the other side you show your obligations, your liabilities, and along with it capital is also shown here. So the capital which is invested by the businessman, by the owner of the business, it is shown as a liability, as an obligation of the business. So it clearly points out how the businessman and the business, they both are separate entities. So it says that accounting records, they are made in the books of accounts from the point of view of the business unit and not that of the owner. Personal assets, personal liabilities, they are not considered while you are recording and reporting the assets and liabilities of the business. So very simple it would be. So now very easily we can answer this question. So you cannot record your own medical expenses in your business income statement because this would be a violation of the business entity concept. You are different and your business is different. Answer is option C. Now let's come to the next question. So this question is under accrual basis of accounting. Now this is a very wonderful concept, accrual basis of accounting. There are basically two bases. One is cash, one is accrual basis. I believe I shouldn't be telling you this at this point of moment because the options are still there and you have to try to answer this question first. So the options are: only cash transactions are recorded, only credit transactions are recorded, both cash and credit transactions are recorded, credit transactions of only expenses are recorded, credit transactions of only incomes are recorded. So basically, let me just make this question more clear to you so that you can try to attempt this one. So it says that there is one basis of accounting, accrual basis of accounting. So the options, what are they saying? So it says that there can be two kinds of transaction. One can be a cash transaction, one can be a credit transaction. So suppose you sell some goods and you get cash for those particular goods. And it may happen that you sell the goods, but you are selling the goods on credit. You will receive money, say after a period of 30 days. Now similarly, the case can be for the purchases. You buy some goods and you pay for them in cash, and similarly you buy some goods and you are going to pay them after a certain period of time. You bought the goods on credit, you are going to pay for them after 30-40 days. So these kinds of transactions, they are going to be there. Then if we are following this credit basis, so there will be something that after 30 days you will be receiving, or after 30 days you will be making certain payments. So the cash outflow and cash inflow is going to be after 30 days, after a specified time period in the credit transactions. So the question is asking what kind of transactions are going to be recorded. Are you only going to record cash? Are you only going to record credit? Or you are going to record both of these transactions? How the things are going to work? The question is basically asking this thing. So friends, there are basically two bases of accounting. One is the cash basis and another one is the accrual basis. Now in the cash basis, what happens is we only record cash inflows and outflows. So suppose I am buying mobile phones for the purpose of reselling them. I'm not paying for them as of now. I'll be paying them after 3 months. So right now I'm not going to record this transaction if I'm following cash basis of accounting. I'm only going to record it after 90 days. Similarly, if I have made the sales but I have not yet received the cash, so again, whenever I receive the cash, then only I'm going to record it in my books of accounts. So the flaw is obvious with this kind of the basis of accounting. You are just not doing what should be done. You are not recording your revenues and expenses properly. You have sold the goods, you have earned the revenue, but you are not recording it. You are just waiting for the cash to arrive to record the transaction. Similarly, you have incurred the expense, you have incurred a liability, but you are not recording it. You are just waiting for the cash outflow to happen. So if you are doing these kinds of things, your profit is not going to come out accurate. You are just going to manipulate things on the basis of cash. So this system is not that good. So practically what we do, we follow accrual basis of accounting. Now in accrual basis of accounting, we are going to record the transactions on the basis of their occurrence, whether or not cash flow is involved or not. So it may be a transaction in which I have sold the goods and received the cash then and there only. There may be a transaction in which I have not received the cash, I have sold it on credit. I am going to receive cash after 3 months. I am going to record both these transactions in accrual basis of accounting. So it is a method where revenue or expenses are recorded when a transaction occurs. Now this occurs is a key word here. rather than when the payment is received or made. So we are not considering cash payment, cash receipt. We are considering the occurrence of the transaction. This is the essence of the recording in the books of accounts. If you are selling on credit, you are going to record the transaction. If you are buying on credit, you are going to again record the transaction. So this ultimately helps in matching our expenses and revenues, and ultimately helps us in finding out the accurate figure of the net profit with us. So this method is a popular one. This is an acceptable method. So here we are recording cash transactions also and credit transactions also. So we are basically concerned with occurrence of the transaction. So I believe now you can easily answer this particular question, that in accrual basis of accounting, we are recording both cash as well as credit transaction. So we are not concerned with actual cash inflow and outflow. If the cash inflow happens then and there only, it's good. If it is a credit transaction, then also it is going to be recorded in the books of accounts. So clearly the answer is going to be option number C. So now here's another question. Let's see if you can get it correctly. ABC Limited purchased an old machine worth rupees 10 lakh for the business of manufacturing soaps. So it's a company, it has bought an old machine. Amount of rupees 10,000 was spent on transporting the plant to the factory site. This machine was transported to the factory and an amount of rupees 10,000 was spent. In addition, rupees 15,000 was spent on its installation as well. The total amount at which the machine will be recorded in the books of accounts would be. So we are being asked what should be the treatment of this particular transaction. So what is being done? A machine has been bought. Now it says that machine has been bought for rupees 10 lakh. But this is not the actual amount that you are paying for this particular machine in totality, because you are also spending rupees 10,000 on transporting the machine. You are spending rupees 15,000 on installation of the machine. Now the accountant of the company is asking you that at what price I should record this transaction. He's aware that you have learned about the basic accounting theories. So he's asking you, at what price should I record the machine? Should I record it at rupees 10 lakh only? Should I record it at a different value? Should I add both of these figures as well? Or should I add one of these figures into my costing? So what should be the cost of the machinery? This is being asked to us. Whether the transportation and installation, it should be transferred to a separate account, should be recorded separately, or whether this expense should also be clubbed with the cost of machine. This is what we are being asked here. So I believe you have understood the question. So friends, when we talked about basic accounting concepts, we learned there is a cost concept. Now this cost concept says that you are going to record all the assets in the books of accounts at their cost, at their purchase price. I just explained the same when we were talking about the different basic accounting concepts. Now what is this purchase price? Now this purchase price, it not only includes the cost of acquisition, but it also includes the cost of transportation, installation, and everything that is needed to make the asset ready to use. Now the machinery which was purchased, it was not ready to use as it was. This 10 lakh, it did not give me a usable machinery. I had to spend some amount, maybe on repairing it, maybe on transporting it, maybe on installing it. So everything else that I'm going to spend on this particular machine to make it available for use for me, to make it ready to use for my business, I'm also going to include it in my cost, because this is very much logical. So this concept, it says that purchase price, it includes cost of acquisition, transportation, installation, and everything you spend to make the asset ready to use. It also says that the concept of cost is historical in nature. So as I have already told you, that we are going to record any asset at the amount at which we had purchased it. It may happen that the asset's value now may have appreciated considerably. Land purchased in 1992 was 1 lakh then, and in today's scenario it may be worth rupees 1 crore. But in our books of accounts, we are going to record it at rupees 1 lakh only, because this cost concept, it says so. It is also referred to as historical cost concept. Everything is going to be recorded at their historical value. So now let's try to answer this one. So 10 lakh, it's definitely going to be included. This is the cost of acquisition, plus cost of transportation is going to be included. This is what? This is 10,000, and cost of installation is going to be included. It is 15,000. So let's total it. So it's going to come out to 10,25,000. So clearly the answer is going to be option number D. So friends, let's move on to another question. Now this another question is something that you should be able to answer. Now we have understood about the different accounting concepts. You just have to apply those concepts. Just think carefully and you will be able to arrive at the right answer. I don't believe accounting is something which is very different. I believe accounting is very logical. Everything has a proper logic to it. So whatever you seem reasonable, whatever seems reasonable to you, whatever you feel that this is how the things should be, it is exactly so in accounting. So here the question is, which accounting concept argues that a conscious approach should be adopted in ascertaining income so that the profits of the enterprise are not overstated? Full disclosure, conservatism, objectivity, consistency, accounting period concept. So we have discussed briefly about all these basic accounting concepts. So just have to make out which accounting concept it talks about following a conscious approach, or rather I should say a cautious approach with regard to ascertaining the incomes. We do not want that our profits should be overstated, because if our profits they are overstated, some users may make wrong decisions. So we want that profits should never be overstated. Profits may be understated, this is okay, but you should never overstate the profits. You should never try to show a business so rosy, a business so good, but exactly it may not be so rosy, it may not be so good. So this is something which we do not want. And for this purpose, we have a basic accounting concept, and this concept is what you have to identify in this particular question. So the concept which is involved here is conservatism concept. Now it is also called prudence concept. You should be conservative. You should be prudent with regard to recording of incomes in the books of accounts. So it says that whenever you feel that there may be a profit in future, there may be a big income in future, just do not recognize it as of now because it is uncertain. But if you feel that there may be certain expense in the future, there may be a certain loss in the future, you should provide for it as of now only. So if you feel I have sold some goods to Mr. X worth rupees 10,000, you feel like this, and you feel that Mr. X is only going to pay me 6,000 rupees. So this concept says that you should book rupees 4,000 as your loss today only. Should recognize that 4,000 is going to be my loss. But if you expected that I am going to get some money, get some extra money in the future, you should not book that particular income. You should have to be very conservative about the profits, because if the profits do not happen and you record it in the books of accounts, the users of accounting information, the users of your accounting reports may make certain decisions which may not have been made if they would have known the correct picture. So we want you to show all the expenses, all the losses which may not be certain as of now, but we do not want you to show uncertain incomes. You have to show only the incomes which you are certain about. So it says that concept of conservatism, it requires that profits should not be recorded until they are realized, but all losses, even those which may have a remote possibility, are to be provided for in the books of accounts. So there are different examples, different practical examples which are being followed. So for example, you have certain closing stock with you. I have bought 20 phones. I have sold only 10. The 10 are still in stock with me, and I have to show them in my books of accounts as my stock. So I should show them at cost or market price, whichever is lower. I cannot say that I bought these for 10,000. Now the market price is 15,000. I should record it at 15. No, I'm not going to do it. I'm going to be very conservative about it, because that 15 is not mine as of now. It's only going to be mine in future when I sell these mobile phones. So as of now, be conservative. Just record it at the cost only. If you feel some person is not going to return your money, just make a provision for that. Just recognize it as an expense as of now only. So they are just the basic applications of the principle of conservatism or prudence. So now we can easily answer this question. That the conservatism concept, it requires that you should follow a very cautious approach in ascertaining income so that the profits of the enterprise are not overstated. So you may even be asked a question like this, which accounting concept it says that you should recognize, you should book all the expenses which may be uncertain, but you should not book any income which is uncertain. You may be asked like this also, a question maybe like this also. So you have to remember that this concept is conservatism or prudence concept. The answer is option number B. So thank you friends, this was our today's discussion on the basic theoretical aspects of accounting, the theory base of accounting. We have talked about the basic accounting concepts. They are the basic assumptions which every accountant is going to follow, and now I believe you are also aware about those assumptions. So if you now take a look at some books of accounts, some balance sheets, some financials, you know that they are the underlying assumptions on the basis of which these accounts, these reports, they have been prepared. So that's it for today. Thank you. Bye bye. Take care and all the best.